Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I have two paper money trades for you today in two high-profile names. First, Supermicro, a company that's been under a lot of scrutiny lately, a lot of news coming out with earnings and a corporate outlook after the bell today. The stock has been moving all over the place, as you probably know. We're going to look at a trade there, and then we'll look at Microsoft, a stock that is down, off its highs significantly and getting to a pretty significant area. So we'll look at both those today. First, Supermicro. Now, Supermicro's got news coming out after the bell, and this is a strategy if you wanted to play for movement in either direction. Now, you can pick a direction more weighted higher than the other, but this is a trade that is not bullish or bearish. It is based on movement. It has risk if there's no movement in Supermicro, and it performs well on movement in either direction, and I'll show you what that is. It's called a back ratio spread. So I went out to the February 21st expiration, so a week and a half from where we are now, and I sold the 30 call in the February 21st expiration. Then in the same expiration, I bought two of the 41 calls. If you look at the expected move from now until next week, it's about $11. How did I get the strike with? Right there. That's the help on the Thinkorswim platform that gave me. So I did my spreads at about $11 wide. If you look, the 41 where I'm long to is right at the money. And then the downside is where I have the short call. So this is a trade that breaks even. By the way, the credit on it is about, I put it in about $2. It's trading about $2.05 now. Credit. Remember, you're selling one, buying two for a credit. So a big move on the downside. The break even here is about $32. And it's profitable. You simply make your credit on the downside. On the upside is where it gets interesting because you have an extra unit, right? And the break evens here, if you put them up and you see where they are, the break even is about $32 on the downside and about $50 on the upside is where these break even. And after that, you have an extra call unit that gives you unlimited upside exposure to Supermicro. So this is a trade, again, the risk on this trade is if it were to go right to the strike of $41, the 30-41 call vertical would go to full value and the 41 calls would go out worthless, right? So there's where the max loss would be on this spread. It is a spread that plays for movement in either direction. It does poorly if the stock stays right here. Okay, that's our first one in Supermicro. Now, let's get to our second trade, and that is Microsoft. Now, Microsoft, if you look on the chart, is getting to some interesting areas in terms of support. If you look back really to last August is when it started hitting these areas and started gaining some support there right around that $410 level. And that's where it's only slightly above that right now. So the trade I looked at here was it's something we do a lot on this little podcast. It's the complex trade where we sell. We're going to do a bullish trade in Microsoft based on where it is. If you're not bullish in Microsoft, this is not the trade you should be looking at. We sold the 405-395 put vertical in the February 14th. So just this week, selling the 10-point put vertical in Microsoft, and then using that credit to buy the call diagonal. It's a little different. We're not buying a call calendar, which we do a lot. We're buying a call diagonal on the upside. So we're buying the 410 in the March 7th, selling this week's 417.5. Why? Look at the expected move for this week, about $7.5. So buying the 410, selling the 417.5. Now, the debit on that, we put it in around $6.70. It's already trading higher than that. It's trading $7.5 now, so it's trading a little higher than it was. Maybe do you want to adjust your strikes? You can certainly do that and bring down that net debit, but we went out to the March 7th, which adds a little premium to that trade. So you're looking for a move this week to the 417.5 strike. And then the risk on this trade is that short put vertical this week, right? You've got risk of about $1,000, the $10 put vertical, plus the $7 now that you spent on the call diagonal, right? That they add together to add your risk on the downside. This is a play that is slightly more aggressive than normal. It's got a little delta. If you look at the delta here, it's about a 45 delta. You can lower that delta by moving some strikes around, but this is a upside call diagonal, which is one trade you could just do, or a downside, a short put vertical, which is also one trade that you can do. Combine those trades and you have the more complex trade. All right, that's our show for today, everybody. We'll see you tomorrow with another edition of Daily Trader. Have a great day, everyone. I'm Kevin Hincks.